Okay, so we've given everyone a chance to join. So very good evening to all. Welcome to our webinar this evening on the subject of understanding the NHS pension scheme for hospital doctors. My name is Andrew Burwood and I'm joined by Lizzie Lloyd this evening. We're both partners in Larkin-Gowan, specialising in all things medical. So we'll go on to the first slide. And just to set out that this is the second in a series of pension webinars that we are doing. The first one was held last month, and that was on the pension scheme for GPs. So if you are a GP and you missed the first session, it is available on YouTube. Links are included on our website. So if that one is more appropriate to you for your particular purpose, then by all means join or have a look at our website and access the recording on there. So this evening we're going to be talking about understanding the NHS pension scheme for hospital doctors. On the 14th of June we are covering the tax changes, particularly for GPs. The following week on the 21st it's going to be the tax changes for hospital doctors, and that would then complete the series. Please also take a view of our website for relevant insights. We have a number of blogs and podcasts on there which will be of particular relevance to you all. So without further ado, I'm going to pass you over to Lizzie, who's going to kick off the webinar.
Thank you, Andrew. Good evening, everybody. So, yeah, we're going to start to talk about just quite basically what a pension scheme is, the types of pension scheme you can have, and then the types of NHS pension scheme and how those pension benefits are built up. So we're not really going to cover the tax changes and charges that some of you may have had the unfortunate event of being charged to. They're in the second lots of webinars. So types of pension schemes. So you can have two types of pension scheme that you contribute to, and they're either a defined benefit or a defined contribution. So a defined contribution is you paying contributions into a pension scheme. There is it's probably like a personal pension or something like that. And you've got a pot of money that's then your money, because it's what you've contributed, would have been made up for tax relief, and that's invested so it can go up and down. And then when you're ready to draw down on that pension pot, there's various ways you can access that. And then you have a defined benefit scheme, which is what we're going to talk about tonight. So a defined benefit scheme is you will still make pension contributions, but those contributions don't go into a pot with your name on it. There's no actual pot of money for you, because your benefit of being a member of that scheme is determined by a particular way of how that pension is built up. So tonight we're going to be talking about the final salary scheme and a career average earning schemes. So the contributions are just what the scheme has determined you need to contribute to get the benefit as prescribed under that scheme. So most public sector schemes and employer pension schemes as well may be defined benefit schemes. I can go on to the next slide, please, Andrew. So yeah, two types of defined benefit scheme, and we are going to be covering both of those tonight because they are applicable to hospital doctors. I would also say, although this is for hospital doctors, it's what we call officers. So that will be any member of staff in the NHS pension scheme. It's distinct basically from GPs who are in a practitioner scheme. So officers would be hospital doctors, some positions with, say, the ICBs, maybe officer, and also if you're a GP or practice manager in a GP, but you're a partner, you'd be an officer scheme as well. So yeah, two types of defined benefit pension scheme. The final salary, so basically you make contributions, but the pension you get at the end is defined based on your final salary or the best of the last few years of your final salary, and a fraction, which we'll cover in a bit more detail on the computations later, or a career average scheme. So this is the benefit is then based on everything you have earned throughout your career, and a guaranteed pension will be a proportion of that. And there may be tax-free cash lump sums with the pension schemes, which again, we're going to look at when we get to the computations. So, as I said, the NHS pension scheme is a defined benefit scheme. So it's not a contribution scheme. So quite a lot of time people say, well, how much is my pot value? So although there is a deemed pot value, it isn't how much you have popped into that pot by way of your contributions. It's based on this benefit. I would note we're talking about England NHS pension scheme here. There's a different NHS pension scheme in Scotland. If you have at any time worked in Scotland, you may have a pension in the Scottish NHS pension scheme, or you may have moved that into your England one. So the pension benefits, and what we mean when we say benefits is what pension you're going to get at retirement, grows over the life of your membership, i.e. being in this scheme, and linked to your pensionable pay and how many years of service. So as I say, contributions not factored in at all. Now, it's very confusing at the moment because we have quite a lot of schemes going on, and you will probably be a member of more than one of these schemes. So we've got the 1995 scheme, or it's called, they tend to be called by the year they came out. So you've got the 1995 scheme, which also had a 2008 part to it as well. So people who joined after the 1st of April 2008 went into the 2008 section of that existing scheme. So the 1995 and 2008 are two different sections of one scheme. Then you've got the 2015 scheme that came in on the 1st of April 2015. And then we'll cover a bit about the moving across in a moment, but that scheme obviously starts on the 1st of April 2015, but you've also got this McLeod judgment, which means maybe the 2015 scheme doesn't start until later, confusingly, but we have got a slide to cover that later. As I said, your member benefits depend if you're a practitioner or an officer. We're covering officer members tonight. And there it notes that the different class of those members, so practitioners, GP partners, salary GPs, locums. So still, there's a lot of relevance in this webinar to those GPs, but just not how the computations are worked out in the 95 and 2008 section. So this webinar specifically for practice staff, hospital doctors. Okay, so the 1995 scheme for hospital doctors is what's called an 80th scheme. So it's final salary, and basically it's based on the best of the last 3 years of full-time equivalent earnings. That doesn't mean you have to work full-time or you will be necessarily penalised for not working full-time. It's just based on what is your full-time equivalent pay, the best of it in the last 3 years before your retirement, and then you get a pension from that based on the number of years service over 80. It's an 80th scheme. Now, if you've worked part-time, it's the number of years service that is prorated. So, you know, if you worked half-time for 40 years, then the fraction would be 20 over 80. So it's the fraction that's reduced for part-time working, but it's always based on the full-time equivalent pay. So that's how the pension benefit is worked out. And as I say, we've got a computational example in a moment. And then in the 1995 scheme, there is an automatic tax-free lump sum, which is as I say, tax-free, which is 3 times the pension. Now you are able to give up some of the annual pension to take a bigger tax-free lump sum if that's what you decide to do at retirement. The normal retirement age of this scheme is 60. So what that means is if you decide to take the pension before 60, they're going to stretch the benefits, they're going to pay the benefits over a longer period of time, so they're going to pay less per annum. It's around a 5% reduction for every early 1 year of retirement. If you draw your pension benefits after 60, then you won't get the reduction, or at 60, obviously. So then, as I say, you'll normally be a member of either the 1995 or 2008 scheme. So these are one scheme, confusingly 2 sections. You won't be a member of both those schemes. So you'll be a member of the 2008 scheme if you joined the NHS pension scheme for the first time after the 1st of April 2008, or you were in the 1995 scheme and maybe you had a period abroad or out of the scheme that was more than 5 years, and when you joined or rejoined, it was after the 1st of April 2008. Or if you were in the 1995 scheme and you made the choice when the 2008 scheme came along to move your benefits from the 1995 section to the 2008 section. So some people did take that out, but you should be aware if you did. If not, the information will be with the NHS pensions. But yeah, it's unlikely. Well, it's not completely unlikely that you won't be a member of both bits. Like I say, you might be in the 95 and the 2008 if you had a gap of more than 5 years in between. Okay, next slide, please. So going back to the 1995 scheme, let's just look at a computation of how the pension benefits are worked out. So I'm ignoring McLeod at the moment. So let's just assume the 1995 scheme was still in existence at the 31st of March 2021. And this individual had accrued up to that point 8 years service at half time and 15 years service at full time. So the number of days service are halved for the 8 years and full for the 15 years. Totals 6,935 days. We count it in days. And they had full-time equivalent pensionable pay of 100,000. So the basic pension is then 100,000 times, as I said, the number of years service over 80. So we've just put it into days there, 6,935 over 29,200 days is what the 80th fraction is. So this pension is £23,750. And that is banked based on that full-time equivalent pay and those years service. And the tax-free lump sum is 71250. Now, I would mention at this point, because I'm not sure it's on a later slide, but if it is, we'll glance over it when we get there. Your pensionable pay should be clear from your payslip. It's your basic pay, but there may be extras that are included in that as well. If you have done any salary sacrifice, then that will reduce your pensionable pay. But when those salary sacrifices end, it will increase it back up again. But you may have additional posts where you're working that aren't pensionable. They usually say NP by them on your payslip. So it is worth checking that you are only pensioning what is deemed to be pensionable income, because we have had the odd occasion where a hospital trust has pensioned a short period of extra work, which would, although the person has paid pension contributions on it, it's never going to benefit in their last 3 years of earnings and give them a greater pension. So it was agreed that that should be non-pensionable and was stripped out. Okay, so that, I appreciate there's a lot of numbers on there, but hopefully you've got the gist of how the 1995 scheme is calculated. That's at March 2021. So let's go on to the next year just to see how it then builds from the following year. So the same doctor then works another year, but they do 6 PAs for this year. The full-time equivalent earnings is 105. It's just that their pensionable pay is only 63,000. So their service is increased by 219 days, so just those 6 PAs, up to 7,154 days. So then the pension increases to 25,725 because the full-time equivalent pay has increased and the then number of days has increased, even though they're only doing 6 PAs, and the lump sum has increased as well. So that's how that one, that's how the 1995 scheme pension is worked out and how it builds year on year. Now, probably you're aware that the 1995 scheme has ceased. but it still retains a final salary link. So even though you may not be contributing to this particular scheme anymore because of the new schemes that have come on and that you've been moved across to, as long as you haven't had a break in service of more than 5 years, it is still going to be linked to your final salary. Obviously, the number of days won't change because you're not accruing any extra days benefit in this scheme. But when your full-time equivalent pay goes up to, I don't know, 110, 120, then this pension will increase as well, because that's the only way it will increase. It doesn't increase for inflation. So 1995 section was a 1/80th scheme. The 2008 scheme is a 1/60th scheme. Still the best of your last few years of full-time equivalent pay, and everything else about the calculation stays the same. So I have just noted a typo in that third bullet point down. That should obviously be over 60 years because it's exactly the same as the 95, but this is a 60th scheme, not an 80th scheme. There is one difference, another difference, I'm afraid to say, in that there is no automatic tax-free lump sum with this pension scheme. So although you get slightly more pension for your earnings, you're not going to get this tax-free lump sum. You can get a tax-free lump sum, but it involves giving up pension benefits per annum to get the tax-free lump sum. So you would get a reduced annual pension on a 12-to-1 ratio. We've got an example of that. Also, this has a later retirement age of 65 rather than 60. So you remember I said before, if they draw it before 60, you're going to lose a bit of your pension because the pension benefits are going to be stretched. So same with this one, you're going to get more pension on the 60th basis rather than the 80th basis, but you get it later and it doesn't come with an automatic tax-free lump sum. So I think we might have a calculation of this on the next slide. Yeah, we do. So not exactly the same calculation as before, but somebody who's been in the 2008 scheme, we've got some half-time, some full-time working, some total days service, 3,650, full-time equivalent pay of 100,000. So this time it's the same calculation, but the 3,650 days is divided by 60 years, which is 21,900 instead of 29,200. So this person will get has built up at March 2021, an annual pension at retirement of £16,667. No automatic tax-free lump sum. But if this person was at retirement age and they wanted to get, say, 30,000 lump sum, then on the 1-to-12 ratio, they'd be giving up £2,500 of pension per annum. So their annual pension would drop to 14,167, but they would get which is taxable, I'd say. Annual pensions are taxable, but the tax-free lump sum, they would then get at 30,000. Again, ignoring McLeod. So once more, that was at March 2021. The next slide just builds on that to March 2022. So another year of full-time earnings. The days service goes up to 4015. The pensionable pay has gone up to 106. So the pension has gone up because of the extra year service and the slightly higher lump sum, slightly higher full-time equivalent earnings. Still no automatic lump sum in the 2008 scheme, but again, another example of how they could give up pension to take a lump sum. I should have said at the start, we're accountants, not financial advisors. So although we understand the NHS pension scheme because we need to help our clients complete their tax returns, we can't advise on what you should do. So, if you're coming to retirement and you don't know what to do regarding drawing a pension or taking a lump sum, you will need to speak to a financial advisor. Of course, we can run the numbers for you. That's not a problem. Right, so if it wasn't confusing enough already, we are now at an even more confusing junction. So the 2015 scheme was introduced on the 1st of April 2015, not very imaginatively titled. It was part of a wider change in public sector pension schemes. So it wasn't just the NHS pension scheme. Now, at that date, people were either automatically transferred to this scheme or they maybe were transferred at a later date. It depended on their age. Now, what you had already built up in the 95 or the 2008 scheme is not lost. So you do not, that doesn't, unlike the transfer from the 95 to the 2008, you've still got a pension in that old legacy scheme. And as I said, it's still got a final salary link. So you've got that pension that you can then draw at the normal retirement age. It's just from the 1st of April 2015, you started to build up pension benefits in a new scheme, and this one was frozen, subject to McLeod. Now, this is not a final salary scheme. It's still defined benefit, so the pension benefit is still worked out in a defined way, but it's not linked to the final salary. It's linked to what you have earned as a doctor, your pensionable pay every year, and basically you get 1/54th of that as a pension. There is an example because I know there's a lot of numbers in here. It's a career earnings average scheme is what we'd call it. So everything you've earned is added together. It's then dynamised up, so increased up for inflation plus 1.5%. And then whatever that pot is, there is a pension of that of 1/54th. So the benefits for this accrue in exactly the same way for GPs and hospital doctors. So practitioner and officer members accrue the same way. You still have to know whether you're an officer or practitioner because there's still some differences on the contributions, which we'll come to later. Again, no automatic tax-free lump sum, but again, you can give up some pension for a lump sum on a 1:12 ratio. The normal retirement age is linked to the state retirement age. So potentially that could mean if that moves to 70, let's hope not, then obviously that's the date that you would draw this pension potentially as well. And again, you can draw it early, but you lose some of those, some of the annual pension by having it for longer. Okay, so let's just go straight into an example of the 2015 scheme. So pension will pay of 110,000. So the pension you have brought is a 54th of that, £2,037. So that is an annual pension at retirement, £2,000, £2,000, for example, every year. But it's then revalued for inflation based on what the consumer price index factor was during the year, plus 1.5%. So it goes up by 2% to March 2021. So it's actually then £2,078 is the pension. And of course, that will keep going up by this dynamisation every year. So if we roll forward to March 2022, you've got the 2078 banked, but then you've got another 112,000 of pensionable earnings. A 54th of that is a 2,074. And then the inflation plus 1.5% is applied for that year, which was 4.6%. So at the end of March 2022, you've banked £4,343 of annual pension. And that cannot go down. You know, that is banked at the end of every year, rolled forward, add on the 54th of pensionable pay for the next year, inflation, etc., etc. But as you'll note, there's no reference to number of days service in here, no reference to part-time or full-time, because it's all based on your pensionable pay in the year. Okay. Good, next slide,
Just before
please.
we move on to that one, Lizzie, if you can hear me okay, just thinking about the value that you are obtaining in pension in respect or in comparison to the contributions that are physically paid. So if we look at that particular example where the pensionable pay is £110,000, the member would pay at 13.5% employee contributions £14,850 in actual contributions to that scheme. If you take off the tax relief, and let's say for this example it's 40%, so the true cost to you would be 60%, that's a cost of £8,910. So a cost of £8,910 is buying you an index-linked, inflation-proof pension of £2,037, which I think Lizzie and I would both say that if we could achieve that in a private pension, we would be absolutely over the moon. So I think it's worth just putting that into context, because the NHS pension scheme is a fantastic scheme. And yes, the tax charges can be difficult to manage, which is coming up on a future webinar, but the actual benefits that you get from that pension scheme are fantastic.
Yeah, so it's sort of a 4 or 5 year return, isn't it? As long as you live 4 or 5 years after you've drawn the pension, you've made back up the cost of it, probably, haven't you?
Absolutely. Yeah.
And obviously the pension scheme comes with other benefits as well, death in service, ill health retirement. So
Critical illness, yeah.
awesome.
Yeah.
Thank you, Andrew, for that insight.
Pleasure.
Right, what slide are we up to? Well, it's over to you, I think, actually, Andrew.
It is over to me. So we are going to talk about now the, they've asked me to share my webcam. Unfortunately, you're going to have to look at me again. So yes, contributions. As a hospital doctor or an officer, you only pay employee contributions on your pensionable pay. That's slightly different for GPs, type 1 practitioners, who also have to pay employer contributions on top. So the employer's contributions, they are listed out there, but they are irrelevant as far as hospital doctors and officer posts are concerned, because you do not pay those. The employee contributions are actually based on tier rates, and you'll see a table on your screen setting out what tier rates are applied. They're far more complicated than they used to be, but you can still follow those ones quite easily. The one point to note is that there was a change with effect from 1st of October 2022. It was supposed to come in from 1st of April 2022, but it got deferred by 6 months. And you will see that the highest contribution rate that was payable prior to 1st of October 2022 was 14.5%. That reduced down to 13.5% with effect from 1st of October 22 for those with pensionable pay in excess of £111,377. There is a further rate change. The date is still to be confirmed, but we are anticipating at this stage that it will come in from 1st of October of this year. You'll see that it's reducing by a further 1% down to 12.5%. So when we're talking about value for money, you're actually going to be paying less if you are a full-time individual. You'll be paying less in employee contributions than what you have done previously, so saving 2% over the last 2 years. Moving on to the next slide. Okay, so the contributions that you pay, if you are a member of the 1995 or 2008 scheme, those contributions are based on full-time equivalent earnings. Slightly different for 2015 scheme members in that they are based upon earnings in each officer position that you hold on an annualized basis. So just to put a bit more context to that, annualization means that if you work part-time for the whole of the pension year, that runs to 31st of March each year, then the percentage tier rates that we saw on the previous slide, those are based on the pensionable pay for those part-time hours. However, if you only work for, say, 6 months of the year, then that salary that you've earned is grossed up for a whole year when assessing the percentage that is applied to that pensionable pay that you've got. If you have multiple officer posts, those are not aggregated when looking at the percentage tier rate, although that is under consultation. We believe the process has been delayed until it can be automated, so not quite sure when that will be, but it will happen in due course. So, how does the NHS pension scheme know what you have earned to determine what your pension is when you come to draw benefits? So your employer, because you're paid via PAYE, your employer notifies NHS pensions annually of your pensionable pay and full-time equivalent pensionable pay. So it's different to GPs, either type 1s or type 2s, that's partners or salaried partners in that they have to complete pensionable profit forms. If you are a salaried hospital consultant or an officer, it's all dealt with through PAYE and therefore notified by your employer. Although the 2015 pension scheme benefits are now built up based on actual pensionable pay, the full-time equivalent figure is relevant to the final salary link for your 1995 or 2008 scheme benefits, as what we've seen previously with the slides that Lizzie went through. It's really, really important, I can't stress this enough, it's really important that you check every year that the correct figures have been reported. If there are errors in what is being held by NHS pensions, then your pension benefits and pension tax charges, which will come on a later webinar, could be wrong. So NHS pensions would have to go back to your employer to rectify the situation, and that's best done sooner rather than later. So the next slide, I'm handing back to Lizzie.
And I'm here. Yeah, so as Andrew said, it's really important that you check your pension benefits, because if you find an error in years to come, you've got to go back maybe to your trust, got to find the pay slips to rectify it. It's much easier to do it year on year and just make sure it keeps up to date. So we're going to go through in a little while a total reward statement. So a total reward statement provides an estimate of your NHS annual pension. It's not a future estimate. It's, you know, if you've got a private pension, usually they write to you and say, this is your pension now, but we estimate at 60 it's going to be this. It's not that. It's just based on that particular day and your earnings to date. I'm not actually sure if you can get access to the total awards at the moment, because it's usually accessed via gov.uk through a verify link, but that's now closed. So we're just waiting to see what's going to replace that. You should be able to get access to it through your electronic staff records, but if not, then you can contact the pensions agency and they should be able to provide it within 40 working days for you. It may not be up to date because obviously the pension scheme year ended 31st of March 2023, has now ended, but your employer, your trust, has got some time before they have to update NHS pensions with the figure. So it may be that if you got it now, it wouldn't show your 2023 figures on there. Now, when you get it, assuming that you haven't joined the pension scheme since 2015, there will be more than one part to it, because it will show your legacy pension and the 2015 pension. Yeah, and they're usually updated annually as part of this refresh. So what they do is your employer will give the information to NHS pensions. NHS pensions will process it and refresh the total award statement at certain points in the year. But because of the McLeod remedy, that may be delayed this year. Okay, are we going on to a total award statement? Oh no, we're just saying why it's not up to date. Yeah, okay. So saying that you can access it, it may not be up to date and it may not be available because of any one of these reasons. We find it's normally accessible for hospital doctors more so than practitioners, but it may be that you've got some complications with it. You might have a pension sharing order if you've been through a divorce, or it may be that your employer hasn't updated it or there's questions on it. So again, if you can't get access to it, the quickest way is to speak to NHS pensions. They do have a telephone number. I think it was on the previous slide. Sometimes they don't answer that because they're very busy, but normally if you drop them an email, they do respond in a couple of days. Thank you, Andrew. And next slide, please. Yep, okay. Now, tiny font probably for you, but hopefully you'll be able to follow through what I'm going to talk through here. So this is an example of a total award statement in the 1995 section. So you'll see at the start it says the date you joined the pension scheme, so you can verify that. I would say you can also ask the pensions agency for a service extract, which will also show your number of years service, and that is quite useful to get because obviously you've got a final salary link and number of service pension in the 95 scheme. So 1995 scheme, date you've joined, then at the top you've got the normal pension age, which will be 60 in this scheme. If it was the 2008 scheme, it would say 65. Then you've got your pensionable pay. So first check is that that agrees to the pensionable pay for that year, which would be reported on your March payslip. And then the date it's updated to. It will say 31st of March 2015 at the moment, because that is when the 1995 scheme stopped for McLeod, but it will change. So then you've got the standard benefits. So the benefits of £21,623 are worked out on that fraction, number of days service, over 80 times the pensionable pay. So although you can't see that calculation there, if you have a calculator handy, you quickly turn those 17 years and 20 days into days, divide it by 29,200, times it by the 101,000 of pay, you will get the 21,000 pension, and then 3 times of that will be the lump sum. As I said, if you are not sure that the reckonable membership, the year's service, is wrong or is right, then you can ask for a service extract, which will show every position you've had, what dates you had them, and whether they were whole-time or part-time. So then you'll have that tab, the 1995 section, or you might have one that says 2008, but you'll also have this other tab, which is on the next slide, which is the 2015 scheme. So this one is the non-final salary link one, not based on year's service. So this is based on your pensionable earnings. So started on the 1st of April 2015. So for the pension scheme year ended 31st of March 2016, this individual earned 84,000. 1/54th of that pension is £1,567, and then it was revalued, dynamised by 1.4%, because CPI was actually negative in that year. So it's the negative CPI plus 1.5% that you get. Negative does count. So you've got every year there, you can check the pensionable earnings are correct. These are your actual pensionable earnings, not full-time equivalent, whereas on the 1995, it will be full-time equivalent. And that's where we sometimes see errors, that your trust hasn't reported the correct full-time equivalent salary to NHS pensions. So the 1995 pension won't be right. Then the pension earned for every year is added up, dynamised by those factors, and in this example gives a pension of 13,000 as shown in the box above, but no automatic lump sum. Okay, next slide please. The McLeod judgment. Andrew, are you going to come back up? And we've been hinting at the McLeod judgment.
So we could spend quite a bit of time talking about this, but you'll see on your screen that there's an absolute marvellous podcast that's been recorded by Lizzie and Louise. The link is there on your screen, and that covers all things to do with the McLeod judgment. I will really briefly mention one thing, and that is we talked about the previous pension schemes, 1995 and 2008. When the 2008 pension scheme became available, and if you were a member of the 1995 scheme at that particular point in time, you did have a choice as to whether you remained in the 1995 scheme or moved to 2008. Now, you may have moved to 2008 because the accrual rate was higher. However, the 2008 scheme has a retirement age, standard retirement age of 65. So as a consequence of that, if you made the active choice to move from 1995 to 2008, then the McLeod judgment, in other words, the ability to take the pension benefits accrued between 2015 and 2022, that will not apply to you. It only applies if you have 1995 pension membership and you were automatically transferred into the 2015 scheme on the 1st of April 2015. Did that come across clear enough, Lizzie?
Yeah, that's a great point. Thank you. Yeah, we can't
Okay.
see you on the screen,
Oh, that's not a
but
bad thing.
still looking at me.
I can
Yeah.
see you, but that's fine. Yeah,
So,
so
so sorry.
go on, you go.
I was just going to say, so the reason we've gone through tonight, each of those schemes, even though you may think, well, hold on, I moved out of the 1995 scheme in 2015, is because you possibly didn't, because the McLeod judgment will effectively put those 7 years from 2015 to 2022 back in to that old scheme. That's the option that you have got. So 7 years in a legacy scheme, which has a final salary link, and then but the 2015 scheme will apply to everybody from the 1st of April 2022, no matter what. But yeah, there's the podcast hopefully helps unravel some of that, and it's obviously it looks like it's being presented by a much younger version of Lizzie Lloyd from a photo many years ago, which we like much better. Okay, so we're just drawing to a close now. I've just got one more slide. We have got some time, so if you've got any questions, do make sure you put them in the question box. You know, now's the opportunity to get those answered. So the last slide is just talking about the changes on retirement options. So up until now, or up until early this year, you know, that basically you decided if you're going to take your pension at the normal pension retirement age, you took it fully. If you took it from the 95 scheme, you couldn't then carry on contributing to the new scheme. If you wanted to return to work, then you had to have a break in service and a reduction in the number of hours. But there's been a number of flexibilities introduced, which I'm not going to go into in massive detail because they are more financial advice, but basically now you can draw partially part of your pension. You can carry on contributing to the new scheme. The 24-hour retirement rules have changed in that you still need to retire for 24 hours. So you do physically retire to enable you to draw your pension, but you haven't got to abate your working in that first month to 16 hours, which is what you used to have to do before. There are still some abatements to pension rules that apply. So if you draw your pension fully and you're in a certain classification of officers, then there may be a restriction on what you can earn afterwards. But there's quite a lot of information actually on this on the NHS Pensions Agency website as well. So I think that draws us to a close this evening. Is Andrew going to pop back up? Any questions?
If I am here.
Ah, you're hiding. Oh, there you are. Yeah, so if anybody's got any questions, please raise them now. Otherwise, I don't think, unless Andrew got any more nuggets of wisdom.
Not at this time of the day. I think I would just remind everybody of the sessions that we've got coming up. So the next one we have is on the 14th of June, which is the tax charges in relation to the NHS pension scheme for GPs. The following one is on the 21st of June, which is tax charges in relation to the NHS pension scheme for hospital doctors and officers. And also just again, a reminder of all the content that's included on our website, all of the insights, blogs, podcasts. There's a huge amount of information on there. And of course, we are available to speak in person and we'd be delighted to hear from you if you'd like to contact us direct. So I think that's everything from that aspect. We do have to put up our standard disclaimer. I'm sorry, but we do, if I can get to it. Oh, there's those awful photos, so I'll skip past that one. So because this is a generic session this evening, this is not tailored advice for anybody. We just covered through the implications of the NHS pension scheme for you. So we do have to make our disclaimer there, which you'll see on screen now. I think that's everything, Lizzie.
Yeah. Well, I hope everyone found it a useful session. If you've got any questions, then please get in touch. Otherwise, have a good evening.
Thank you very much.